What's up investors, Sneers here. REITs are a great way to invest in real estate for dividends, but the way they are set up makes them hard to grow. You see, REITs must pay more than 90% of its net income back to the investors as dividend. It creates for us as investor to get the dividend back, but it doesn't leave any capital within the REIT to reinvest and grow. Yet, REITs does grow through various ways. Understanding how REITs grow can take your investing in REITs to the next level. Instead of buying REITs for their current yield alone, treating them almost like bonds, you can invest in REITs with great growth prospects by understanding how they can grow and understanding how to look at the management to understand their growth, and then you can get not only the dividends that the REIT will pay you, but also the capital appreciation through the REIT growth itself. Guys, if you are new to the subject of REITs or want a refresher on the basics of investing in REITs, I have a video made up for you. You can see it in the description below or in the card above me. Moreover, I have multiple videos on REITs, so if you're interested in the subject as a whole, check out the playlist in the link in the description below. With that said, let's go on with the video. Before we talk about all the ways that REITs can grow, I want to talk first about how a REIT can fund any external growth. As REITs pay most of its income back to the investors, they must get funding from an outside source. This means that they either offer more shares to the public or raise more debt. Each venue here is important to note. For share offering, because it's far more common for REITs to offer more shares to the public than to a regular company in the stock market, it's far more important that you note to look at every metric on a per share basis. Because the metric itself can grow if the REIT offer more shares and then use the capital to buy more assets, but it doesn't mean that on a per share basis the REIT performed well. So keep in note to always look at a per share basis when you look at REITs. And for that, it's important to note that it's a very valid way for REITs to grow. If you are used to look at companies with high cash flow that doesn't get any debt in the stock market, you need to know that it's okay for REITs to have some debt, maybe more than you are comfortable with if you come from high growth companies with high cash flows. Guys, before we continue, if you find this kind of content valuable and you want to help me grow, hit the subscribe button as it helps me a lot. And if you want to see more content for the individual investor from me, consider subscribing to the channel. And with that said, let's continue. Generally, there are two types of growth for REITs, internal growth and external growth. Internal growth focuses on growing the income from existing assets, for example by raising rents. And external growth focuses on expanding the assets of the REIT, for example by purchasing new assets from other real estate investors. Let's go deep into each type and understand how they work. Now let's start with the most obvious way for internal growth, rental increases. Raising the rent on existing assets provides us higher cash flow with no extra investment. But as with every real estate, the ability to raise rent year after year is highly dependent on the market status and where we are in the market cycle. For us as investors, the best way to assess the ability of the REIT to increase the rent year after year is basically looking at the occupancy rate. If an asset of the REIT, be it housing or commercial or malls or whatever, if the occupancy is high, it means that the asset is in high demand. And if the asset is in high demand, it means that the REIT is able to raise the rentals year after year in an easy way. If there is no high demand for the asset, it means it will be much harder to raise the rents and maybe we will lose on this internal growth engine. Next is tenants upgrade. It's mostly available for commercial real estate. For example, if you have a mall, a big mall, and the REIT management gets a very high demand store into the mall, which brings more visitors to the mall. It makes the mall much more valuable for the other tenants, which in turn enables the REIT to raise the rents for the other tenants because now they have more visitors and high value to stay in this particular mall. This of course depends on a really good management for the REIT. The third way is doing refurbishment and development on existing assets. Malls go out of fashion, offices get old and boring, and houses have broken walls, all of which will benefit from refurbishment and development to the asset itself. And this kind of investment usually offer high return with low risk, because you already know what is the demand for the asset, be it a mall or a housing or whatever. You know the current demand and you can assess the extra value from refurbishment or development with relatively low risk. But again, this is highly dependent on the management. Finding these opportunities, allocating the money correctly and doing the right things for the development and the refurbishment of existing assets. But if the management is experienced and does that well, it's a great way to do internal growth with low investment. And the last thing I want to mention in terms of internal growth is capital recycling. Sometimes assets held by the REIT you own are not worth for the REIT to keep owning when others are willing to pay much higher prices for them. Maybe the buyer have different debt structure that make it worthwhile for him. Maybe he's an expert in developing this kind of asset. Maybe it plays nice with other assets this buyer have. Whatever the reason is, the price that they are willing to pay are much more worthwhile for the REIT to sell than to hold this asset, and then using this new capital within the REIT to invest in other venues where it's much more worthwhile for them. This leads us directly to the subject of external growth. External growth is focusing on expanding the portfolio of assets for the REIT. It can be done by buying existing assets or developing completely new assets on purchased land. But to understand external growth, we first need to discuss everything about the financing of the growth. As we discussed in the beginning of the video, a REIT must pay most of its income back to the investors, so it either gets its new financing by raising debt or offering more shares, and this gives an immediate and obvious price to the capital raised. Smart analysts use a measure called WACC, weighted average cost of capital. The formula for WACC gives us a weighted number for the cost of capital. So for example, if you can raise debt in an interest of 7% and the price for raising more cash from shareholders is, let's say, 10%, and you weighted the amount based on how much you raise from each one, you get to a certain number. Let's say, for example, 8%. Then you take this number, this 8%, and you compare it to any investment. If an investment, any asset you want to buy, is expected to return less than 8%, it doesn't make sense to do that. It must be more. That's important to understand, because by understanding it, you might be able to tell whether a REIT is able at all to do external growth. For example, if a REIT is out of favor and its stock price is too low, it means that raising more capital through offering more shares on this kind of stock where the price is too low, the price for that might be too high and it might not be relevant for any venture of getting more investing. Same goes for raising debt. If the REIT has too much debt already, it means that raising more debt will usually get very high interest rate, and then it doesn't make sense to raise this debt because there will be no opportunity that justify this debt. So this kind of REITs must first focus on internal growth, getting the REIT to a good place by lowering the debt amount and getting the price of the stock high enough that it will make sense to offer more stocks, and only then they can focus on external growth. And as for external growth, REITs can either buy existing assets, which require management that knows how to allocate the capital correctly and do good investments, or do a new developments on purchased land, which is far riskier and requires much more know-how from the management. Doing completely new development is highly lucrative usually in very hot markets, because if the market is very hot and there is high demand for any kind of real estate, usually the prices of existing assets are too high with low return rate for the future. But if you are able to build your own asset, then the return is very high and really great terms. But of course, with the high return here, there is very high risks. You might underestimate the cost of the project might get too long, and you might start it where the market is very hot and end it where the market crashed. For example, if you started a project in 2007, it will take a few years, and by 2009 the market crashed and you lost all your investment. So this can be very lucrative, but it can be very risky, and it requires management that really knows how to do it very well. So pay attention for what management you invest in when you pick your REIT. Guys, that's it for today. I hope you enjoyed this video and it was valuable for you. Consider subscribing to the channel if you want more content for the individual investor, and I hope to see you next time. Bye bye.